Hi student, welcome to another session of Manifested Online Classes. So in this class, I want us we continue with topic number 1, and that is accounting for asset and liabilities. And in this session, I want us we look on the subtopic accounting for leases under IFRS 16. So as far as this particular topic is concerned, we're going to look on a number of issues, or basically we're going to discuss a number of issues. One, we're going to define what is a lease. Number 2, we are going to look on the various types of leases, or various ways in terms of how leases are classified under IFRS 16. And then from there, we also look on how leases are accounted for by the various parties in a lease, because in a lease, we have a number of parties, actually 2 parties. We have the owner of the asset, who is called the lessor, and then we have the other party who has been given the right to use the asset and who is called the lessee. So therefore, those are majorly some of the issues we are going to discuss as far as this particular topic is concerned. So to start with, I want us we define what is a lease, and basically when we talk about a lease, this refers now to a contract, or basically part of the contract which conveys, or basically which gives the right to use an asset to another person for a specific period of time in return of some consideration or in payment of a consideration which is known as the minimum lease rental. So therefore, it is that particular contract whereby one of the parties will be given now the right to do what? To use the asset for a specific period of time in return of some periodical payment. So therefore, here we can say that a lease is a contract Yes, so therefore in this case we are saying that when talk about a lease, basically we are saying that this is a contract, or basically part of the contract that conveys, or basically that gives the right to use an asset for a specific period of time in return of some periodical payment, in some or in return of some periodical payment which is known as the minimum lease rental. So therefore, it is basically that particular contract whereby the owner of the asset will be able to give the right to another person to use an asset for a given period of time in return of some periodical payment. And basically we are saying that those periodical payments, we refer to them as the minimum lease rentals. In very simple terms, when talk about the minimum lease rentals, we are talking of the rent now which is supposed to be paid to the person who has been conferred, or basically who has been given the right to do what? To use an asset for a specific period of time. And therefore, it is important to note that in a lease contract, basically we have 2 parties. We have 2 parties. We have the owner of the asset, who in other terms we refer to as the lessor, and then we have now the person who has been given, or who has been conferred the right now to use what? The right to use an asset. Therefore, we can say here that in a lease, we have 2 parties. So we can say that there are 2 parties. There are 2 parties involved in this contract. And those 2 parties include who? Number 1, we have the person who owns the asset, the owner of the asset. And basically the owner of the asset, we refer to this as the lessor. And then number 2, we have the person who has been conferred, or basically given the right to use an asset, and basically that particular person is called the lessee. So therefore, the owner of the asset is called the lessor, and basically this is a person who will have conferred, who will have given the right to use an asset to another person who is called the lessee. Now, in this particular case, we have various ways in terms of how leases are classified in accordance with this particular standard here, that is IFRS what? IFRS 16. So number 1, we have something called a finance lease. Number 2, we have something called an operating lease, and then we have something called a short-term what? A short-term lease. So therefore, we can look on the types of leases, or basically the various ways in terms of how leases are classified, types of leases. Number one, we have what we refer to as a finance lease, a finance lease. Some books refer to this as a capital lease, lease. And number two, we have what we refer as an operating lease, And then number three, we have what we refer as the short term. The short term what? Lease. So therefore, leases are classified into those three what? Categories. Now, first of all, when talk about a finance or basically a capital lease, we say that these are particular leases which transfer substantially all the risk and rewards associated with the asset to the person who is called the lessee, the lessee. So therefore, that particular lease there, the risk and also the reward associated with the asset will be transferred to the person who is called the lessee. So therefore, we can say that a finance lease, which is also known as a capital lease, we are saying that this is a lease. This is a lease which substantially transfers all the risks and rewards associated with the asset to the lessee, So meaning that this particular type of the lease here will transfer all the risk and rewards associated with the asset to the person who has leased the asset. Basically, what that means is that if, for example, you lease an asset from the owner, any benefit or basically any reward which is associated with that particular building, for example, the rent which is being generated by that particular building will have now to be collected by you as the lessee. And number two, the risk associated with that particular building will also be transferred to you. It basically means that you have the responsibility to insure that particular building, because if something happened to that particular building, like the building is damaged and something like that, then you have the responsibility to do what? To repair that particular building. So that's why we are saying you have the responsibility to ensure that the building is actually what? Is actually insured. So that in this case, we say that the risk and also the rewards associated with the asset are transferred now to the person who is called the lessee. So number two, we have the other type of the lease, and that is operating lease. Operating lease. So when talk about an operating lease, this is actually defined to be any other lease. This is defined to be any other lease other than finance what it is. In other terms, what that means that under finance or basically under the capital lease, the reward and also the risk which are associated with the asset are not transferred to the lessee. So therefore, we can say that this is any other lease Yes, so therefore, in this case, we are saying that this is any other lease other than what? The finance or basically the capital what? Lease. And therefore, in this case, we have said that the risk and also the rewards which are associated with the asset are not transferred now to the person who is called the lessee. And then from there, we have the last type of the lease, which is called the short-term lease. The short-term lease. When talk about the short-term lease, this refers to any lease whose lease term basically do not exceed 1 year or do not exceed 12 months. When talk about the term of the lease, we are talking of the period of time when the lessee has been given the right to use the asset. So mean that if you lease an asset from the owner and the agreement is that you should use that asset for a period of time which does not exceed 1 year or basically 12 months, then we refer to that as what? As a short-term what? Lease. So therefore you can say that this is a lease whose lease term does not exceed 1 year. does not exceed what? 1 year, or basically does not exceed what? 12 months. But the two main classification of leases under this particular standard here, that is IFRS 16, is what referred as a finance lease or and also what referred as operating what? It is mean that for accounting purpose, the two main ways in terms of how leases are classified is the capital or basically what? The finance what? It is. So therefore, that is the first thing you need to know. You need to know what is a lease, which you have said is basically that particular contract whereby the owner of the asset will be able to confer, will be able to give the right to use an asset to a person who is called the lessee, and basically the lessee is supposed to pay some periodical payment, which we have referred to as what? The minimum lease rentals. Equally, we have said in a lease contract, we have two parties. We have the owner of the asset, who is called the lessor, and then we have the person who has been conferred the right to use the asset, who is called the lessee. And then in this case, equally, we have said that leases are basically classified in three main what? Categories. So actually, we have said we have two main categories, a finance lease, and then from there we have what? The operating lease. Then from there, I want us to look on how leases are accounted for by the person who is called the lessee. So by the person who is called the lessee, so we can look on what we refer as accounting for leases. Accounting for leases by the lessee. By the lessee. So first of all, who is the lessee? The lessee in this case, we have said, is that particular party, is that particular person who has been conferred the right to do what? To use the asset for a specific period of time, and then he is supposed to do what? To pay some periodical payment. Now, one of the important points to note here, as far as accounting for leases by the lessee is concerned, is that the lessee, in accordance with IFRS 16, should not classify the lease as an operating lease or a finance lease. So basically what that means, that classification of the lease as an operating or finance lease, it only applies to the owner of the asset. The owner of the asset is who? Is the lessor. So therefore, that is the first important point, that the lessee should not classify the lease, a lease contract as an operating or the finance lease. The finance what? It is, and basically I've said that this is a requirement of IFRS 16. It is also important maybe to note at this point that IFRS 16 is basically a new standard which was issued to replace the old standard on leases. The old standard on leases was IS 17, International Accounting Standard number 17, and that particular standard had given the lessee the option to classify the lease as an operating or basically what? Finance lease. And therefore, what most of the companies were doing after leasing asset, most of the company were accounting for those particular leases as operating leases. So what that means is that most of the companies were avoiding showing liabilities in their books of accounts by accounting for the leases as what? As the finance leases. Because once a company leases an asset for a long period of time, the company should be able to show the liability which will be in form of the lease rentals to be paid over the lease term. But what I'm saying is that under IS 17, most of the companies were avoiding that, showing liabilities in their balance sheet, and therefore they were classifying for all leases as operating what? Leases, whereby companies were only accounting for the lease rentals which was paid in a certain financial year as an expense. But now, this particular standard here, IFRS 16, considered that as a limitation associated with IS 17, and basically now IFRS 16 prohibit now the lessee from classifying the lease as an operating or what? A finance lease. And therefore, once a company or basically an entity leases an asset, what that particular entity should recognize in its books of account are two items. Are two what? Items. Number one, we have something called the lease liability, and number two, we have something called the right of use what? Asset. So therefore, we can say that on initial recognition, on initial recognition, the lessee should recognize, or basically record number one, right of use asset, right of use asset, and number two, something called the lease liability. Something called the lease what? Liability. So these are the two items which now the lessee is expected to initially record in his books of account once now the lessee has leased an asset. Has leased what? An asset. Therefore, in this particular case, what we are going to look, we are going to look on how we determine these two items. How do we determine the right of use asset? And number two, how do we determine the lease what? Liability. So I think we can start by looking on how we determine what we refer as the lease liability. Lease liability. So the lease liability, essentially, this represents the present value of the minimum lease rentals which now the lessee is expected to pay. So basically what that means is that if, for example, you lease an asset and you lease that asset for the next 5 years, then there is the minimum lease rentals you should be paying annually. Remember, in this case, you have said the minimum lease rentals is the rent to be paid on annual basis. So therefore, for you to be able to determine the lease liability, what you do, you have to discount, or basically you have to get the present value of the minimum lease rentals you are going to pay over the lease term. And therefore, in this case, we can say that the lease liability, this is equal to present value of minimum lease rentals, not paid at the inception date, of the lease, discounted using the interest rate implicit in the lease. Interest rate implicit in the lease. Implicit in what? In the lease. So therefore, for us to be able to determine the lease liability, what we do is that we get the present value of the minimum lease rentals, which is not paid at the inception date of the lease. So basically what that means that in getting that particular present value of the minimum lease rentals, we do not take into account, we do not include any minimum lease rentals which is paid at the inception date of the lease. Like maybe we take a small illustration here. We are told that a company leased an asset, and that company is supposed to pay a minimum lease rentals. Remember, in this case, we have said that when we talk about the minimum lease rentals, we are talking of the rent now to be paid by the company on annual basis. So we assume that that company is supposed to pay maybe an amount of 100,000, and you are told that this particular rent is payable in advance. Is payable in what? In advance. So being payable in advance, that means that the rent for each financial year is supposed to be paid at the start of each year. At the start of what? Each year. And also we assume that we are told that the lease term, so in this case when we talk about the lease term, basically we are talking of the period of the lease. The lease term maybe we are told are 4 years. Are 4 years. Also, in this case, the examiner will have given you something called the interest rate implicit in the lease. So when we talk about the interest rate implicit in the lease, this is the rate now which you should use for discounting purpose, because in discounting, in getting the present value, you must be having an R. So R is now what? The interest rate implicit in what? In the lease. So let's assume that we are told that the interest rate the interest rate implicit in the risk, implicit in the risk, maybe is 10%. Is 10 what? Is 10%. Now, in this case, how do we determine the risk liability? How do we determine the risk liability? So we are saying the risk liability will be equal to the present value of the minimum risk rentals not paid at the inception date of the risk. In this case, when we talk about the inception date of the risk, we are talking of the date when the risk commenced. We are talking of the date when the risk commenced. So in this case, maybe we can have a schedule here, a certain schedule. So we are saying our risk here is for how many years? For 4 years. So this will be year 1, year 2, year 3, year 4. So how much rent is supposed to be paid annually? So we know that the rent to be paid annually here is 100,000, and basically you say that this should be paid at the start of each year. So what that means is that the first rent will be paid at the start of year 1. Basically the start of year 1 we refer to that as time 0. The other rent will be paid at the start of year 2. The other rent will be paid at the start of year 3. And the other rent now will be paid at the start of year what? Year 4. So to determine the risk liability here, to determine the risk liability, we are saying that this will be equal to the present value of the minimum risk rentals not paid at the inception date, not paid at the inception date. So not paid at the inception date. So in this case, when we talk about the risk, minimum risk rentals not paid at the inception date of the risk, we are talking of the rent now which was paid at the start of year 2, at the start of year 3, at the start of year 4, because this particular amount here was paid at the inception date. At the inception what? A date. So therefore, let's determine the risk liability, which will be equal to 100,000, which is now the minimum risk rentals. And then what we need to do, we need to discount that. So how do we discount this? We discount this by multiplying that with the present value, interest factor of annuity, at which rate? So this 10% will be our R at the rate of 10%. And then in this case, we are discounting the rent which was paid at the start of year 2, at the start of year 3, and also at the start of year 4. So therefore here we consider rent for how many period? 3 periods, or basically yes, 3 periods. So therefore here our N will not be 4, but rather our N will be what? Will be 3 years. Because in this case we are saying this particular risk rentals which was paid at the inception date of the risk does not form part of the liability, So therefore we take 100,000, and how do we compute that? To compute this, there is a formula which we apply here. We take what? We take 1 minus 1 plus R. Our R in this case is 10%, so this will be 1.1 raised to power negative 3, and then we divide that with R, which is 0.1. So whatever we get here, this is now what referred as the risk liability. There is what? Liability. So therefore, it is important here to note that the risk liability, basically this is the present value of the minimum risk rentals, which is not paid at the inception date of the risk, because the amount which has already been paid at the inception date of the risk, that does not form part of the liability, So, and then we discount that using what we refer as a interest rate implicit in what? In the risk. And then once we have determined that particular risk liability, then what we should do, we should be able to amortize that. We should be able to do what? To amortize that, because now whatever you are going to get here as the risk liability, it basically represent the present value of what now the lessee is expected to pay over the risk term. So basically what that means that at the end of the risk, then the risk liability should be what? Should be 0. But we are going to look on how we do that particular amortization, specifically when looking on an illustration what? A question. So then from there, we can proceed and look on how do we determine the other items there. Remember, in our case here, we have looked on how we determine the risk liability. So next, I want us we look on how we measure, how we determine the value of what? of use asset. So let's look on how we determine that. That is right of use asset. So we have right of use asset, right of use, abbreviated as ROU, right of use asset, right of use asset. So to determine this, basically we add like 3 items. We add 3 items. One, we take the what? The present value of what we refer as the minimum lease rentals, present value of minimum lease rentals at inception date of the lease, and then now to this we add payment. So to that we add what? The payment made before all at the inception date of the lease. So when we talk about this payment made before or at the inception date of the lease, we are talking of any rent which was paid at the date when the lease commenced. For example, from this particular small illustration which I've given you here, so this particular amount of 100,000, this is a payment which was made at the inception date of the lease. So take into account that. And then to this we also add any initial direct cost, e.g. what we refer as the legal cost. So in this case, when we talk about the legal cost, anytime as a company or as an entity you lease an asset from the owner, then you must have a lease agreement drafted by you, or basically you must enter into a lease agreement. So that particular lease agreement will be drafted by a lawyer who definitely will have to charge you a fee. So that particular fee which will be charged by your lawyer, we refer to it as what? As a legal cost, which is basically an initial direct cost which is associated with what? With the lease. So therefore what we do, we add all this, and basically whatever you get here is the amount for initial recognition of what we refer as the right of use asset. And then once this particular value has been determined there for the right of use asset, then subsequently it must be depreciated on a straight line basis. So therefore you can say that the right of use asset must then be depreciated, Yes, so basically what you're saying is that this right of use asset must then be depreciated at the shorter of 2 periods. One, what we refer as the lease term, and what we refer as the economic life of the asset. So like assuming you are told that the lease term, or basically the term of the lease, 4 years, and then you are told that the economic life of the asset are 5 years. So therefore, you depreciate this right of use asset at the shorter of these 2 periods. You take the period which is shorter out of the 2 periods. So in our case, the period which is shorter, 4 years. So what you do, you take the value you have determined here, and then you divide that with 4 years. Whatever you are going to get now is the depreciation per annum, of which that particular depreciation should be recognized by the lessee here in the income statement as what? As an expense. So therefore, it is important to note that according to this particular standard here, IFRS 16, it prohibits the lessee from classifying the lease as a finance or an operating lease. This standard requires that at the inception date of the lease, once an entity or basically a company leases an asset from the owner, that company should recognize two items in the books of account. One is what we refer as the lease liability, which you have said is equal to the present value of the minimum lease rentals not paid at the inception date of the lease. And then we have said that that lease liability should be amortized over the lease term. And 2, the lessee should be able to recognize something called what? The right of use asset. The right of use asset is basically determined by adding these three items: the present value of the minimum lease rentals at the inception date of the lease, plus any payment made before or at the inception date of the lease, plus any initial direct cost associated with the lease. And then you have said that that right of use asset should be depreciated at the shorter of two period. That is now the lease term and also the economic life of what? Of the asset. But in this case, we have two exemptions, or basically two instances or two circumstances whereby the lessee is exempted from recognizing those two items in his books of account. So mean that at a number of circumstances, the lessee is not required to recognize the right of use asset in his books of account, and what he refers there is what? Liability. Lease liability. So which are those exemptions? Which are those exemptions? Exceptions. So basically we refer to them as exemptions or exceptions from complying with IFRS 16 as far as accounting for leases by the lessee is what is concerned. One of the exception is in case of what refers the short-term lease. The short-term lease. Remember, we defined what is a short-term lease, and we say that these are lease whose lease term does not exceed 1 year or does not exceed what? 12 months. So whenever a company leases an asset and the company has leased that particular asset for a period which is less than 1 year, that company do not necessarily need to recognize the right of use asset and also the lease liability in its books of account. So such a company will just account for the rent which was paid as an expense in the income what? Statement. Number two, or the other exception, is in case of what refers as a lease of an asset, of low value, value. And a good example of this is a lease of a personal computer, So if a company leases such an asset, e.g. a personal computer or even a laptop, which is of low value, that company do not need to recognize the right of use asset and what? The lease liability, but the company will just need to recognize the amount which is being paid as a result of having leased that particular what? Asset as an expense, as an ordinary what? Expense. So therefore, those are the two exemptions, or basically the two instances, two circumstances whereby the lessee is not required to fully comply with the requirement of IFRS what? 16 as far as the accounting for leases are what? Are concerned. So therefore, that what you need to know as far as the accounting for leases by the lessee is concerned. I want us we take a short break, and then once we come back in our next class, I want us we look on an illustration regarding accounting for leases by the lessee. And then once we do that particular illustration, we are going to proceed and look on how we account for leases by the other party, and that is the owner of the asset or the lessor. So therefore, we take a short break, and then we meet in our next class.
Welcome, learner, to our subject of today, research, consultancy, and advisory. We are looking at underlying theories, models of research, consultancy, and advisory. And our focus today in the lesson will be on social systems theory, which falls under selected research and consultancy theories. The social systems theory has been used extensively in social sciences, and the social systems theory is also called or referred to as systems theory. This social systems theory has its conceptual origins in social systems theory and can be traced to the 19th century, to the work of a philosopher, Herbert Spencer, and Emile Durkheim. They extensively looked at social systems, And the social systems theory is the study of society as a complex arrangement of elements, including individuals and their beliefs, as they relate to the whole. That is very critical as it relates to the whole. And in terms of the whole, this refers to a country, an organization, an entity, or a corporation. And specifically when it comes to social systems, when it comes to a company, then the company as a whole is an entity or an organization. And inside that particular organization, according to the social systems theory, there are subsystems within that particular organization. And those systems, the way they relate to each other, they contribute to defining what the whole system is. And when it comes to a country, then within a country, there are systems within a country. Within a country, there are organizations, and those organizations, under the beliefs of those people within that particular country, individuals, they define what that particular country is. In the social systems theory, we are going to look at the basic assumptions of social systems theory, basic assumptions of the social systems theory. And there are 4 assumptions that underlie or underpin this theory. And the first basic assumption is that there is an underlying general order in the world. So 1, there is an underlying general order in the world. So this system assumes or makes an assumption that generally there is the aspect of order when it comes to things, the way things are done in the world. And that's the first basic assumption of the social systems theory. The second assumption of the second basic assumption of the social systems theory is that social ordering is a consistent and dynamic process. Social ordering is a consistent and dynamic process. What this implies is that when it comes to any society, whichever way the society is structured, or whichever way an organization is structured, there will be dynamics in terms of how order is maintained and sustained in terms of that particular working organization or that particular entity. Then the third aspect is that, the third assumption is that all human social behavior is purposive. All human social behavior is purposive. What this underlying assumption indicates is that any kind of behavior that is exhibited by an individual in a company, in a country, or in any system, whether it is a church, mention any group, that particular social behavior that is exhibited, it's purposive, or it has a purpose. So that is the third basic underlying principle underpinning the social systems theory. Then the fourth one is that all forms of social organizations display self-responsibility. All forms of behavior reflect a form of responsibility or responsiveness. So all forms of behavior reflect a form of responsibility or a response. They display a response in terms of the characteristics. So these are the four assumptions which underlie the social systems theory. So the proponents of this theory argue that there is an underlying general order in the world. Then two, social ordering is a consistent and dynamic process. They also argue or assume or underpin that all human social behavior has a purpose, and they argue that all forms of behavior reflect a form of responsibility or a form of response. Then when it comes to the social systems theory, there are certain components of the social system theory. Components of social systems theory. There are components or the characteristics of social system theory which define what the social system is. And these components are: you have an input within the system, you have a process in the system, you have output in the system, and there is a feedback loop from output to input, and then there is the environment within which that particular system operates. So the components of a social system can be seen in a display figure. It can be displayed such that you have a figure or a diagram that indicates the components of a social system. And within this particular social system, we have indicated that this social system will have input, or you can call them inputs. And these inputs as they come, you will have the inputs directed towards the process that they have to be processed within an organizational setting. So you have the processes, you can call them processes, and from processes, then you have outputs. So any system will have inputs, will have processes, and then there will be a loop. There will be a loop from outputs to inputs, which provides feedback. So from outputs, then you have feedback. So this is feedback. And when it comes to the feedback, then within that particular system, then you have the environment. And within that particular environment, there will be stakeholders. Within the environment, there will be stakeholders, and these particular stakeholders could, for example, be consumers. You have suppliers. You have, for example, government, among other members. So you have inputs, you have processes, you have outputs, you have feedback, and then you have environment within which the social system operates. And this is typical for any organization. If you are taking a company, for example, an organization that receives raw materials, these raw materials will be processed through processes. For example, if it is tea, for instance, it will be, for example, brought in as raw materials. It will undergo a process from the green leaf, maybe raw leaf and so on, to semi-processed outputs, which can now be dried. For example, tea leaves may be packaged. Then these ones are now, feedback is given to the output. And then when you have consumers, so from the outputs, the consumers will be there. Suppliers will also be interacting with this particular system and providing the inputs, like now you need energy, you need regulation by government, you need the price controls and so on. So these would form now the components of a social system that is continuously interacting with its environment to be able to provide goods, to be able to provide services within that particular working context. So the components or characteristics components or characteristics of a system, of a social system, will include the things that will define a social system. Will include, we have indicated, one, you have the inputs. Two, you have processes. Three, you have outputs. Four, you have feedback. And then five, you have controls. Now, these controls can be brought in by, say, government. You could be an organization and you are operating maybe in the service sector, maybe tourism sector, or manufacturing sector. So for you to be able to operate, there will be controls that are put in place by a government. There will be codes of ethics that are put in place by suppliers. You will also have consumers. Consumers will also have the bodies that are representing them in relation to the benefits or maybe the rights of consumers. So the system is in constant interaction with its environment. So when the feedback is provided that what has been produced is being accepted by consumers, then that particular system will basically continue working effectively. If the feedback is negative, then wherever the inputs are coming from, there'll be controls implemented to ensure that if consumers are complaining, if suppliers, for example, are not being paid, then it is important that that arrangement is made to ensure corrective measures are taken into consideration. Otherwise, if there are products being produced by a given company or by a given organization, if they don't meet the expectations of the environment, then those kind of products may not be readily acceptable in the market. So those are the components or the characteristics of a social system as envisaged in the social systems theory. And we have indicated you have inputs, you have processes, you have outputs, you have feedback, and then you have controls. So one may ask, so what are the applications of the social systems theory? Applications of the social systems theory. How can the social systems theory be applied, or of what use is the social system? Now, the way the social system has been put forward by its proponents, a social system looks at a system as being more important than the subsystems. So one, the whole is more important than the subsystem. So when it comes to operations within a given work environment or organization, it is important to note that there will be different sections within a particular system or components. But when it comes to the issue of preferences in terms of choices, what should be done, then the outputs or the processes or the components have to ensure, or the players within the system have to ensure that the players as subsystems are not more important than the whole system. So the whole system and its requirements take precedent when it comes to structuring of events and activities. It is also important to note that those making decisions should be aware that the environment within which a system operates is important. So the environment influences how organizations operate. Environments influence how organizations operate. Let us take an example. You have an organization that is in the manufacturing sector. Now, government and government agencies, for example, you have NEMA. If an organization is manufacturing, it is expected to comply to the regulations that have been set by government and its agencies like NEMA. So if that organization does not comply, then that organization may suffer consequences. So the social systems theory try to explain that as organizations operate, those organizations must be sensitive to the environment. The same thing with Kenya Bureau of Standards. So if an organization is operating, then it has to meet the quality mark. If that organization does not meet the quality mark, then that particular organization may suffer in the market, and customers may not be very confident in, or consumers may not be very confident in patronizing the products of that particular organization. So that's another area where the social systems theory underpins or informs decisions within the area of organization operations. Then it's also important to note that another area of application of the social systems theory is that organizational structures should be designed to be adaptive to changes. Organizational structures should be designed to be adaptive to changes. What is noted widely is that change is the only thing that is permanent. So as organizational structures are designed, it is important to be informed by the social systems theory that change will come. So organizational structures should be designed in terms of how they relate to different functions, with that particular understanding that when change comes, this particular structure is flexible enough, can be adaptive to the changes that are anticipated within a given working context. Then it's also important to note that another area or use of the social systems theory is that subsystems have to be aligned to support the main systems. Subsystems should be aligned. Subsystems should be aligned to support the main system. So if you have a country, we have given an example that an organization or a country could be now the main system or the main organization. So the way subsystems are designed, they should be aligned to support the main system so that the main system can be able to function and function effectively. Then it is important to ensure that the principles and concepts should be designed to be broadly applicable. Principles and concepts should be designed to be broadly applicable. So when it comes to organizational settings, if concepts or systems are designed within an organization, those systems should not be designed for just specific functions. Those systems and underlying principles within systems should be designed in such a way that, because systems relate to each other, principles and concepts should be designed to ensure that they can be broadly applicable within the context of operational organizations and so on. Then it is also important to ensure that when it comes to the social systems theory, every system is bounded by space and time. Every system is bounded by space and time. Every system is bounded by space and time. So at any one given event, if the system is supposed to receive, for example, input, then that particular system that is receiving input, that input is expected to come at a particular setting. And that bounding in terms of time may affect the operations of another system. So the issue of space and time should ensure that the way the systems are working, they are properly synchronized, so that if you have the receiving point, you have the processing point, you have the output point, you have the feedback time, then those systems must be interconnected and interrelated to work effectively, as the case might be. Then it is also important that to note that the social system is consistent with the systems thinking approach. The social systems thinking, social systems theory is consistent with systems thinking. Social systems theory is consistent with the systems thinking. So basically what this implies is that in any given organization, it is important that though you have subsystems, you have sections in a department, you have processes like input, processing, outputs, and others. It is important to ensure that for effectiveness of performance of organizations, there must be one approach for the whole organization. So the whole organization must look at issues holistically. Whatever decision that is being taken, the decision has to be taken in the context of the entire organization. So these are some of the areas where application of social systems theory can be able to be applied in management and other operational areas. So in our lesson today, Lana, we have looked at social systems theory as one of the selected theories in the area of research and consultancy. And we have seen that social systems theory is also called systems theory, and it was conceptualized in the 19th century, and it is attributed to philosopher Herbert Spencer and Emil Durkheim, who was a sociologist. And we have seen that the systems theory is the study of society, and it looks at society as a complex arrangement of elements that include individuals and their beliefs, what they believe in, as they relate to the whole. And we have seen that when it comes to the whole, it could be a corporation, it could be a country, it could be a county government, for example, it could be an entity like a church or maybe any other social organization. And we have gone ahead to see some of the basic assumptions of social systems theory, where we have looked at the 4 assumptions. And the assumption 1 is that there is an underlying general order in the world. That is an assumption of the social systems theory. Number 2, social ordering is a consistent and dynamic process. To put things in order, it has to be done consistently, and the process is dynamic. Number 3, the third basic assumption is that all social behavior is purposive. Any behavior that is in an organization, in a work environment, in a group, it has a purpose. Then 4, all forms of behavior reflect a form of responsibility or responsiveness. Then we have gone ahead and looked at the components of social systems theory, where we have looked at inputs, processes, outputs, and we have looked at the feedback loop. And we have also discussed that the social systems theory operates within an environment, and this environment may include stakeholders like consumers, suppliers, government and government agencies. And the components and the characteristics of a social system, we have mentioned them as inputs, processes, outputs, feedback, and controls within the system. And then we have also gone ahead, Lana, and looked at the applications of the social systems theory, where we have looked at 7 of the applications where the social system theory can be applied. And we have indicated that number 1, that the social system looks at the whole, indicates that the whole is more important than the subsystem. There will be subsystems within an organization, but when it comes to the degree of importance, then the whole should be looked at as more important, and than the subsystem. Then number two, environments influence how organizations operate. And we gave an illustration and indicated an organization in the operating in the production setting should be aware that the environment, for example, government and government agencies or suppliers or consumers may have an impact on what the organization does. Hence, it is important that organizations become sensitive to their environments. Then thirdly, organizational structures should be designed to be adaptive to change. So this social systems theory can inform those designing organizational structures so that the organizational structures are designed with an element of flexibility so that they are flexible and they can be able to operate and adapt to changes. Then four, subsystems should be aligned to support the main systems. So the subsystem exists for the purpose of supporting the main. So if it is in a government setting, for example, government agencies and government operational areas must be able to support what the entire government is doing. When it comes to a company, the departments and the sections within a company should ensure they are moving towards the realization of the organizational vision. That is how the social systems theory can inform decisions at that level. Then principles, number five, principles and concepts should be designed so that they are broadly applicable. There should be no principles or concepts that are designed in an organization. If you are designing, say, a system within an organization, then that system should be strong enough and versatile enough to be able to be applied within the organization to achieve the greater goals of that particular organization. Then number six, every system is bounded by space and time. Whatever system that an organization has, whether it is an open system or a closed system, then that system is bounded by space and time. For example, you may have inputs by a particular time, processes must take place by a particular time, outputs must take place. So if you are receiving raw materials, the system of receiving raw materials should be conditioned to the operational cycle of maybe the operational machines, so that if the machines are, for example, uptaking, then that uptaking of raw materials should be done at a particular time. Processes must be, for example, started. Then you have the outputs in relation to the issue of space and time, so that the systems are well synchronized. Number seven, where the social systems theory can also be applied, social systems theory is consistent with the systems thinking, where the whole organization is supposed to think as one. So decision making processes must be synchronized so that the organization is able to operate from one point of command. So that is your social systems theory in relation to selected research and consultancy theories in our lesson that we have completed. And before we finalize the lesson, there is an assignment that you need to work on to be able to consolidate your knowledge in the area of theories as they are applied in relation to the social systems theory. And the assignment is examine the application of the social systems theory of the social systems theory social systems theory in management. So learner, your assignment for today's lesson: examine the application of the social systems theory in management. Thank you very much for being attentive in our lesson today.
Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing the topic of group accounts, and in this session I want us to look on different types of group structure, and basically how we go ahead and prepare the consolidated financial statement in case of those different types of group structure. Now generally we have two types of group structure. The first one is called the horizontal structure, whereby the parent company do have a direct shareholding in a number of subsidiaries. And then we also have another type of a group structure, which is called a vertical group structure. So in case of a vertical group structure, this whereby the parent company will be having a direct shareholding in a subsidiary and also having indirect shareholding in something called a subsidiary. So therefore, maybe in this case, we can say that there are different types of group structure, different types of group structure, including number one, we have the horizontal structure. Number two, we have the vertical structure. And also number three, we can talk of the mixed structure, or basically the mixed group structure. So these basically are the different types of group structure. Maybe you can start with the first one, that is the horizontal structure. So when talk about the horizontal structure, this whereby the parent company do have or is having direct shareholding in a number of subsidiaries. For example, in this case, we can be told that A Limited, which is basically the parent company, has acquired some shareholding in B Limited, C Limited, and also D Limited. So mean that the parent company here do have direct shareholding in a number of subsidiaries. So therefore, you can say that this is where the parent company, remember also the parent company here is called the investor, because it has invested in other entities. The parent company or the investor has a direct shareholding, in two or more subsidiaries, two or more subsidiaries. So the parent company here is having direct shareholding in two or more subsidiaries. So a good example of a horizontal structure, let's assume that we have A Limited, and which is the parent company, So this company may have direct shareholding in a number of subsidiaries. For example, B Limited or A Limited may be having 80% shareholding in B Limited. A Limited also may be having something like 60% shareholding in C Limited, and also A Limited may be having like a 75% shareholding in another subsidiary, say D Limited. Now, this particular type of group structure, we refer to it as the horizontal group structure, because you can see the parent company, which is A, is having direct shareholding in 3 subsidiaries, B Limited, C Limited, and also D Limited. Now, in this case, when preparing the consolidated financial statement, we prepare them in the normal way, just like a case whereby the parent company is having a single subsidiary. Basically, what that means is that when preparing the group account, we add similar items of asset and liabilities of all the companies here. That is the parent company, B Limited, C Limited, and also what? D Limited. So therefore, you can say in this case, the group accounts are prepared in the normal way, i.e. by adding similar items of assets, comma, liabilities, revenue, and expenses, of the parent company and its subsidiaries, So therefore, in case of what we refer as the horizontal group structure, the group accounts are prepared in the normal way. Basically by adding similar items of asset, liabilities, revenue, and expenses of all the companies within the group. The group. So let's move and look on the other type of group structure, which is number two, and that is vertical structure. So in this case, when we talk about a vertical structure, this whereby the parent company is having a direct shareholding in a subsidiary, and then also having indirect shareholding in what we refer as a sub-subsidiary. So therefore, you can say that this is where a parent company is having direct shareholding in a subsidiary company, and also indirect shareholding shareholding in a subsidiary, subsidiary. So the parent company here will be having a direct shareholding in a subsidiary company, and also indirect shareholding in what we refer as a sub-subsidiary. So what do you mean by that? Let's assume that we have three companies, and A Limited here, we are told, for example, acquired 80% of the ordinary shares issued by B Limited, and then in turn, B Limited here has acquired a 60% shareholding in another company here, which is called C Limited. Now, this particular type of group structure, we refer to it as a vertical group structure, because the parent company here, which will be which is A, is having direct shareholding in this subsidiary, and then A Limited, which is still the parent, is having indirect shareholding in C Limited, of which C Limited in this case is referred to as the sub-subsidiary. Subsidiary. Now, when preparing the group account, or basically the consolidated financial statement, in case of a vertical group structure, there are some important points which now the candidate must be able to know, and which basically will help them in terms of preparing the group account of such questions having that type of group structure. So these are some of the important points to note. Number one, when dealing with a vertical group structure, these are some of the important points. Number one is that the candidates must compute the parent company indirect shareholding in the sub-subsidiary. That is the first thing to be done. Compute the parent company indirect shareholding in the sub-subsidiary. Indirect shareholding in the sub-subsidiary. Subsidiary. So how do we compute that particular parent company indirect shareholding in this particular sub-subsidiary? So what we do, we take the parent company shareholding the parent company shareholding in the subsidiary. So for example, assuming A Limited, which is the parent company, has 80% shareholding in B, which is a subsidiary, and then B, which is a subsidiary or basically do have a shareholding over 60% in C. So to compute the parent company indirect shareholding in C, we take the parent company shareholding in the subsidiary, which is 80%, and then times the subsidiary company shareholding in the sub-subsidiary, which is 60%. So in this case, or here we are going to get a rate which is 48%. So here we say that the parent company indirect shareholding in C, or basically in the sub-subsidiary, is 48%. But in this case, despite or even if you get a rate which is less than 50%, still we say that the parent company is having indirect what? Shareholding, or basically indirect control in C Limited, simply because A Limited controls this one, A Limited controls B, A Limited controls B, and then B Limited in turn controls C. Controls what? C. And because this controls this one, and this one controls this one, then in this case we say that this company here, that is A Limited, do have indirect control over the operating and financial decisions which will be made by C Limited, and also A Limited will be having indirect control as far as the composition of the board of directors of C Limited is concerned. So therefore, what you are saying is that provided this company is controlling this one and this one is controlling that one, even if you get a rate which is less than 50%, then that company is still a sub-subsidiary. What that means is that when preparing the consolidated financial statement, you have to consolidate, you have to combine, you have to add together similar items of assets, liabilities, revenue, and expenses of all the companies. So that is the first thing when dealing with a vertical group structure. Compute the parent company indirect shareholding in the sub-subsidiary. Number two is you need to identify the date, identify the date when the sub-subsidiary became a member of the group. So number two, we can say identify the date when the sub-subsidiary became a member of the group, became a member of the group, became a member of the group. And basically that particular date is very, very important, because when, for example, preparing number one, when computing the goodwill of the sub-subsidiary, you compute it on this particular date when the sub-subsidiary became a member of the group. And also when preparing something like the consolidated income statement, you prepare, or basically you take into account the result of the sub-subsidiary from the date it became a member of the group. That is why we are saying it is very, very important for you to be able to identify the date the sub-subsidiary became a member of the group. And actually, the sub-subsidiary is said to have become a member of the group on the later of the two dates between the date when the parent company acquired the subsidiary and the date when the subsidiary acquired the shareholding in what? In the sub-subsidiary. So therefore, you can say that the sub-subsidiary becomes a member of the group, becomes a member of the group on the later of the two dates, on the later of the two dates. So which are those particular two dates? We are talking of the date when the parent company acquired the subsidiary, and the date the subsidiary acquired the subsidiary. Acquired the subsidiary. So basically we are saying that the subsidiary will become a member of the group on the later of these two dates. On the later of these two dates. The later of the date the parent company acquired the subsidiary. So like maybe let's assume that we are told A Limited acquired shareholding in B maybe on 1st of January like 2021, and then B Limited acquired 60% shareholding in C on 1st of January 2022. 1st January 2022. Therefore, in this case, we are saying the subsidiary will be deemed to have become a member of the group on the later of the two date. The later of the two date. The date which is later. Basically, the date which is later is basically this one. That is 1st January 2022. So therefore, when computing now the goodwill on acquisition of this particular subsidiary, we compute it on that date. That is 1st January 2022. And also when preparing now the group account or the consolidated financial statement, we must also know that we are going to consolidate the result of that particular subsidiary from that particular date. That is the other important point when dealing with a vertical group structure. Other than computing the parent company direct shareholding in C, you also need to identify the date when the subsidiary became a member of the group, of which you have said it must be the later of the two dates. So the other important point number 3, point number 3 is regarding the cost of investment. Cost of investment in the subsidiary. Cost of investment in the subsidiary. So when talk about the cost of investment in the subsidiary, we are talking of the purchase consideration which was paid by the subsidiary in acquiring the shares of the subsidiary. In acquiring the shares of what? The subsidiary. Now, this particular cost of investment in the subsidiary usually is split into two parts. So first of all, we compute the amount due to the parent company, or we compute, yes, amount due to a parent company. So when talk about the amount due to the parent company, this is actually the amount which is regarded or which is assumed to be paid by the parent company in acquiring the shares of the subsidiary. So how do we compute that amount due to the parent company? So this one is computed by taking the cost of investment in the subsidiary. We compute this by taking a cost of investment in subsidiary times the parent company shareholding in subsidiary. A parent company shareholding in the subsidiary. Parent company shareholding in the subsidiary. Like in this case, assuming we are told that B Limited, in acquiring the shares of C, may be paid 100 million. So how do we compute the amount deemed to be paid by the parent company? So we take the cost of investment in the subsidiary, which we are given there as 100 million, and then multiply that with the parent company shareholding in the subsidiary. So the parent company shareholding in the subsidiary is 80%. So in this case, we get what? We get 8 million. So this is the amount deemed to be paid by the parent company in acquiring shares of the subsidiary. And this particular amount which we get here is the one which is then used in the computation of goodwill. So we can say that this is the amount used by parent company by parent company in computing computing the goodwill of the subsidiary So therefore, that this particular amount here, we use it in computing the goodwill of what? Of the subsidiary. Then from there, we also compute the amount of purchase consideration due to the NCI. It is important to note that in this particular subsidiary company here, the parent company is having 80% shareholding, meaning that the remaining 20% of the shares in this particular subsidiary here are held by the minority shareholders. And basically we said the interest of the minority shareholders in a subsidiary, we refer to it as NCI, non-controlling interest. So therefore, what we do next here is to compute amount due to NCI. Compute the amount due to NCI. So how do we compute this particular amount due to the NCI? So we take the cost of investment, investment in subsidiary, and then we multiply that with the NCI shareholding in a subsidiary. NCI shareholding in the subsidiary. For example, in this case, assuming the cost of investment in the subsidiary is 100 million, so we have to multiply that with the NCI shareholding in the subsidiary. NCI shareholding in the subsidiary is 20%. 20%. So this will give us what? This will give us 20 million. So this particular amount of 20 million is then deducted from the NCI at the end of the year. So we can say this is deducted from NCI at the year end. NCI at the year end. So when computing the NCI at the end of the year, so that particular amount due to the NCI, we are saying, will be deducted from what? From the NCI. So therefore, it is very, very important to note that when dealing with a subsidiary, for example, in our case here, C Limited, number one, in computing the goodwill on acquisition of a subsidiary, we have to compute it on the date the subsidiary became a member of the group. Actually, we have mentioned something here to do with identifying the date when the subsidiary became a member of the group, of which that should be the data of the two dates. That is the first important point as far as the computation of goodwill of the subsidiary is concerned. Number two is that when taking into account the cost of investment in the subsidiary, we don't take the full amount. If, for example, B Limited had paid 100 million in acquiring the shares of C, that is not the amount we use in computation of goodwill, but we use the amount which is regarded to be paid by the parent, because it is a parent company here which compute the goodwill on acquisition of C. The goodwill on acquisition of C is not computed by B, because it is important for you to note that in a vertical group structure, here we can say generally we have two parent companies. So A is a parent company to B, and then B is a parent company to C. But this company here, that is B Limited, in accordance with IFRS 10, it is exempted from preparing the group account because it is a partially owned subsidiary by A Limited. The company which is
How are you over there? My name is Patrick Kamau Kamure. You are lecturer in taxation. Welcome to today's lesson of public finance and taxation, where we continue looking at the taxation of the business income, where if I can give you a little of recap of what we did, is that we said that there are three businesses that we need to see how they are taxed. One of them is the partnership, is the sole proprietorship. The other one is the partnership, and the third one is the limited company. In our previous lesson, we did the taxation of the sole proprietorship. So for today, we want to go to the next business, which is the taxation of the partnership. So partnership is where we have two or more people who come together to do business together, and they don't register their business as a company. Because of that, we normally say that partnership do not have a separate legal entity from the owners, and that will mean that when you are taxing the partnership, you tax the partners themselves, not the partnership itself, because it is not separate from the partners. They are partners, and the business, they are one and the same thing. So now we want to see how do we normally tax the partnership business. First of all, I want to write over there the introduction or definition of the partnership as I've illustrated. So we have partnership is a business owned by by two or more people which is not registered as a company, and so does not have a separate legal entity. That is the definition of the partnership. But our objective or goal is to know how we usually tax the partnership business. So these are the items that you need to consider when you are taxing the partnership business. So areas to consider, or items to consider: while taxing partnership business. Number one, determination of taxable income. Determination of taxable income, and say this is done using either or a gross profit method or number two, or B, net profit method. What we are saying is that when you are determining the taxable income of the partnership, just like other business, and as we introduced earlier on when you are introducing to the taxation of the business today, any business, when you're determining the taxable income, you either use the gross profit method or net profit method. So the same criteria apply to the taxation of the partnership. You either use the gross profit method or net profit method to get the taxable income. We have Roman 2. Another items that you need to consider when you are determining taxable income of the partnership or taxing the partnership is the following expenses: are not allowable in partnership. i.e. salary to the partner, to partners, interest on capital, interests on capital from partners, to the partners, to the partners, commission and bonuses to partners, drawings by partners, and any private expense of the partners. That is the second thing that you need to know, that those expenses, when they are incurred by the partnership, they are considered to be non-allowable expenses. Salary to the partners, interest on capital, bonuses, the commission, the drawings. In short, we are saying any expense relating to the partner, like private expenses of the partner, we don't allow them when you're determining the taxable income. The third one that you need to consider, the following incomes. Are non-taxable incomes in partnership, i.e. what are those incomes that are not taxable? Interest on drawings, profit on goods sold to partners, and any other income. Any other income from partners. That's another thing, that when you're determining the taxable income of the partnership, if there's any income that the partnership received from the partners, we treat it as non-taxable. This you'll hear like interest on drawings, like when the partner withdraw anything from the partnership, like goods, the cash, they are charged interest. That is an income to the partnership, but it is usually not taxable. Another thing is like sometimes they can have a provision, or the partners can have a provision that if a person wants to buy goods from the business, can buy and they are going to be charged a profit like any other customer. So that profit is not taxable in the partnership, and any other income that the partnership may get from the partners. The fourth one is the income distribution schedule. Distribution schedule. What does that mean? Once taxable income of partnership is determined, it is distributed to partners using income distribution schedule where they bear individual tax burden. They are taxed individually at graduated scale rates in the same way as employment income. after the distribution. The gross tax once determined then set-offs such as personal relief, insurance relief, and withholding tax on investment incomes are deducted. Income distribution schedule has the following format. So what we are saying is that about the income distribution schedule, once the taxable income of the partnership is determined, either using the gross profit or the net profit, we tax the income on the partners themselves, and we tax them at graduated scale rates. Graduated scale rates is the same as the employment income, the way we taxed the sole proprietorship, where once you distribute to the partners, because the partners are the one who bear the tax burden, you tax them individually. It is partner A, how much is the taxable income, tax individually at graduated scales. Partner B, how much is the taxable income, tax them individually. And then once you get the gross tax of each partner, you less the set-off. Set-off, we said that they reduce the actual tax they are supposed to pay, and they are like personal relief, the withholding tax on investment income, and insurance relief if they have life insurance cover, education insurance cover, or NHIF. Now, I want to show you how the distribution is done through the income distribution schedule or allocation schedule. So it has this format: income distribution stock allocation schedule. We start by distributing the taxable operating income, and then we list the partners. Partner A, we are assuming partners are A, B, and then we have a column for the totals. Shillings, shillings, shillings. So the taxable operating income you would have determined using either gross profit method or net profit method. You can distribute it this way. The first one is usually the salary. So salary to partners. If partners have the salaries, if this one had a salary, you put there this one and the